Hey guys, welcome back. We're going to continue where we left off last time, looking at company analysis. So this time we're going to be expanding into financial ratio analysis. Now what this really is about assessing a company's performance using numbers from their company financial statements, such as income statement, balance sheet, and cash flow statement. So why are financial ratios useful for picking stocks or making investments? Well, first off, it tracks company performance. By that I mean, what it does is it determines individual financial ratios for each period and tracks their change in their values over time. And this is done to spot trends that may be developing in the company. You can also use it to make comparative judgments regarding company performance. So comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. So for example, you could use like return on equity as a way to compare between two companies. Let's now have a look at the different types of financial ratios. So we have liquidity ratios, leverage ratios, efficiency ratios, profitability ratios, and market value ratios. And we'll be going through each one of these in this video. So first up, liquidity ratios. So these are financial ratios that measure the company's ability to repay both short-term and long-term debt or obligations. So one of the popular ratios we have is the current ratio. Now this measures a company's ability to pay off short-term liabilities with current assets. And this is the formula. So it's current assets divided by current liabilities. So I'm going to be using Nike as the example in this video, showing you how the calculations work using real numbers. And you can see some companies, what they do is they actually provide some of these ratios for you in their 10K or their annual reports. And Nike is one of those where it provides us with the current ratio, which you can see here. Then we have the acid test ratio. So this is a similar formula. The only difference between this and the current ratio is it takes away inventories from current assets. Now, the reason it does that is because sometimes stock or inventory is hard to get rid of, so it's not as liquid. So that's why it takes that out. And this is actually my preferred ratio when it comes to looking at liquidity. I prefer the acid test ratio over the current ratio. So if we apply the formula using Nike's numbers, so you got in 2020, it's 1.59. In 2019, it was 1.39. So you can see the number has improved year on year, which is a positive. And the higher the number, the better, because it means Nike is able to cover its short-term liabilities. Next up is leverage ratios. So this is used to evaluate a company's debt levels. The first one we have is the debt ratio. Now this measures the relative amount of a company's assets that are provided from debt. So you've got the ratio as total liabilities over total assets. If I use the numbers from Nike's 10K, this is the numbers we get. So for 2020, it's 1.35, and for 2019, it's 1.62. So what that suggests is the debt levels have either gone down or the assets have gone up, more likely to cover the liabilities, hence why the number's gone down. Then there's also the interest coverage ratio, which I think this is for me, this is what I tend to use more out of the two. I would use the interest coverage ratio. And all that's doing is it's showing us how easily a company is able to pay its interest expenses. So the formula for that is the operating income divided by the total debt service. Now when you look at this, you can see for 2020, lower than what it was at 2019. So to be honest, the interest cover for Nike in 2020 is actually quite low. This really should be at least above 1. Otherwise, the risk here is lenders may not be willing to borrow the company money. Then we come on to efficiency ratios. So efficiency ratios are used to measure how well a company is utilizing its assets and resources. So we have asset turnover ratio. So this measures a company's ability to generate sales from assets. And this is a formula, net sales over average total assets. Then we have inventory turnover ratio. So this measures how many times a company's inventory is sold and replaced over a given period. So the formula is cost of goods sold over average inventory. And we can see that Nike has provided us that ratio in the 10K. And here it is. And then we have receivables turnover ratio. So this is where it measures how many times a company can turn receivables into cash over a given period. The formula is net credit sales over average accounts receivable. Now, efficiency ratios are useful for measuring the operational efficiency of a company. For me personally, they don't play a key role in making trading or investment decisions or picking stocks. The way I see this is efficiency ratios are your kind of bread and butter. They keep the lights on. Now here is where it gets interesting. Profitability ratios, which measure a company's ability to generate income relative to revenue, balance sheet assets, operating costs, and equity. These are, for me, a high priority metric. Understanding the profitability ratios is important for trading and investment decisions. So we'll start with the gross margin ratio. This compares the gross profit of a company to its net sales to show how much profit a company makes after paying its cost of goods sold. So the formula is gross profit over net sales. And if we take the numbers from Nike, you can see they've already calculated this for us in their 10K again. Then we have operating margin. So this is the same as gross profit margin. The difference here is it's using operating income instead of gross profit. So you take operating income or operating profit over net sales. And finally, we have return on equity ratio. This is the one I talked about earlier, where you can use it to compare against different peers or companies or competitors. So what this does is it measures how efficiently a company is using its equity to generate a profit. So the formula here is net income over shareholders' equity. And again, Nike has given us this ratio in their 10K. And this is the number here. Now, some companies will actually have targets for their return on equity. It's something they look at to kind of guide traders or shareholders of where they want their target returns to get to. And last but not least, we have market value ratios. So these are used to evaluate the share price of a company's stock. This is arguably the most relevant for traders and investors. Understanding market value ratios such as the dividend yield ratio. So this measures the amount of dividends given to shareholders relative to the market value of the share. So if we look at the formula, that's dividend per share over share price. And using the market data for share price and Nike's 10K for how much dividends are paid, we can work out the dividend yield in 2020 was 0.97%, and in 2019 it was just over 1%. So a dividend yield of under 1% is not great, and the company is not seen as one of the more higher dividend yield paying companies. But this company is known to be more of a growth company, so you wouldn't expect high dividends for a company like this. So then we have earnings per share. Now this is what gets released in the quarterly earnings for US companies. So this is a key number that people look out for. The earnings per share ratio measures the amount of net income earned for each share outstanding. And the formula is net income over total shares outstanding. And again, Nike has given us this number in the 10K. Then we have price earnings ratios. So you might have seen analysts at banks or investment firms talk about PE ratio. And what they're trying to say is they're trying to compare a company's share price to its earnings per share. So the formula is share price over earnings per share. And again, this is given in Nike's 10K. And the idea here is to understand how overvalued or expensive the share price is relative to the company's earnings. And you can see here Nike's PE ratio almost doubled from 31 in 2019 to around just under 62 in 2020. So there you have it. That covers financial ratio analysis. As always, I hope you found this useful. Remember to hit that subscribe button. Thanks again for watching, and see you at the next one.